I have spent my entire career avoiding commodities. For over 70 years, I have told anyone who would listen that commodities are a terrible investment. They sit there. They do not produce anything. They do not pay dividends. They do not compound. You buy gold or oil or copper and you just hope someone pays you more for it later. That is not investing. That is speculation. And I do not speculate. I invest in productive assets. Businesses that generate cash flows, farms that produce crops, real estate that collects rent, assets that create value rather than just sitting there looking pretty. But today I am going to tell you about the only two commodities I would own for the next decade. And I am going to explain why these two specific commodities are different, why the supply and demand dynamics are so compelling that even someone who has avoided commodities for 75 years recognizes that owning these assets makes sense, not as speculation, not as a bet on price movements, but as a rational response to fundamental economic forces that will drive prices higher for years, regardless of what happens in the short term. Before I reveal the two commodities, let me explain why I have historically avoided this asset class. Because understanding my objections will help you appreciate why these two exceptions are so remarkable. The first problem with commodities is they produce nothing. When you own a share of Coca-Cola, the company uses your capital to manufacture beverages, market the brand, distribute products, and generate profits. Those profits either come back to you as dividends or get reinvested to grow the business further. The asset is productive. It creates value. When you own a bar of gold, it just sits in a vault. It does not work for you. It does not generate cash flow. It does not build brand equity or expand into new markets. A bar of gold today will be the exact same bar of gold in 10 years. It has not grown. It has not compounded. The only way you make money is if someone else is willing to pay more for that same bar of gold. You are entirely dependent on the greater fool theory. Someone else has to value it more than you did. That is not investing. That is gambling on psychology. The second problem with commodities is price volatility with no anchor to fundamental value. When I buy a stock, I can calculate what the business is worth based on its cash flows. I can estimate a reasonable price to pay. If the stock falls below that price, I know it is cheap. If it rises above, I know it is expensive. I have an anchor. I have a framework for making decisions. Commodities have no such anchor. What is gold fundamentally worth? Nobody knows. It is worth whatever people feel like paying based on fear and greed and inflation expectations and dollar strength and a million other factors. Oil can trade at $30 per barrel or $130 per barrel, depending on whether there is a glut or shortage. Copper can swing 50% in a year based on Chinese economic data. This volatility is not tied to any underlying productive capacity changing. It is just supply and demand swinging wildly. Most investors cannot handle this volatility without making emotional mistakes. The third problem is that commodity prices are ultimately mean reverting. When prices spike, producers respond by ramping up production, miners dig more copper, drillers pump more oil, farmers plant more wheat. This increased supply eventually overwhelms demand and prices crash. When prices crash, producers cut back, mines close, drilling stops, farms plant less, supply falls, and eventually prices recover. This cycle repeats endlessly. Timing the cycle is nearly impossible. Most commodity investors buy high when prices are spiking and everyone is excited, then sell low when prices crash and sentiment is terrible. They lose money consistently despite the asset itself being fine. For these three reasons, I've told people for decades to avoid commodities, own businesses, own farms, own real estate, own productive assets that generate cash flows. Do not speculate on shiny metals or barrels of oil. And I have practiced what I preached. Berkshire has never owned gold. We have never speculated in commodity futures. We have avoided the entire asset class. But we have owned commodity-related businesses. We own Burlington Northern Santa Fe Railroad, which ships coal, grain, crude oil, and other commodities. We own energy companies like Occidental Petroleum and Chevron, which produce oil and gas. We own utilities that consume natural gas and coal to generate electricity. We understand commodities from the business side. We understand the supply chains and the economics and the dynamics. And from that position of understanding, I can tell you that right now, today, there are two commodities where the supply and demand fundamentals are so compelling that even I would own them directly. The first commodity I would own for the next decade is energy, specifically crude oil and natural gas. I'm grouping these together as energy because they serve similar purposes and face similar dynamics. And the thesis for owning energy is the most straightforward supply and demand story I have seen in my 75 years of analyzing markets. Let me start with demand. The world consumes about 100 million barrels of oil per day. That is every single day, 100 million barrels. This demand has grown almost every year for decades. During COVID, demand fell briefly to about 90 million barrels per day when everyone stopped driving and flying. But within 2 years, demand recovered fully and continues growing. Why does demand keep growing? Because there are still billions of people on Earth who consume very little energy compared to developed countries. The average American consumes about 20 barrels of oil per year when you account for gasoline, jet fuel, diesel, petrochemicals, plastics, and everything else derived from oil. The average Chinese person consumes about 5 barrels per year. The average Indian person consumes about 1.5 barrels per year. The average African person consumes less than 1 barrel per year. As these populations grow wealthier, their energy consumption increases. This is not speculation. This is observable fact. Every country that has ever developed economically has dramatically increased energy consumption in the process. There is no alternative path to prosperity. Even with all the talk about electric vehicles and renewable energy, oil demand continues growing. Yes, some European countries are using less oil because they have built out alternatives, but their reduction is swamped by increased consumption in China, India, Southeast Asia, Africa, and Latin America. Global oil demand is projected to reach 110 million barrels per day by 2030. That is 10 million more barrels per day than today. Where will this supply come from? This brings me to the supply side of the equation. And this is where the story becomes compelling. Oil supply is constrained and will remain constrained for the next decade minimum. Why? Because the oil industry dramatically underinvested in new production from 2015 to 2023. During this period, the industry spent less on exploration and development than at any time in the past 30 years. Why did investment collapse? First, oil prices crashed in 2014 and stayed low for years. When oil was $40 per barrel, most new projects were uneconomic. Companies could not justify spending billions to develop fields that would lose money at prevailing prices, so they stopped investing. Second, environmental and political pressure intensified. Governments made it harder to get permits. Investors demanded that oil companies return cash to shareholders rather than invest in new production. ESG mandates pushed capital away from fossil fuels. Major banks stopped lending to oil projects. The combined effect was a massive reduction in capital allocated to finding and developing new oil supplies. Now, you might think this is fine. We want less oil production to fight climate change. But the reality is that demand keeps growing. If you restrict supply while demand grows, prices must rise. Basic economics. And that is exactly what has happened. Oil traded at $40 in 2020 during COVID. By 2022, it reached $120. Today it trades around $80. I expect oil to trade between $80 and $120 for most of the next decade because supply simply cannot keep up with demand growth. The supply shortage gets worse over time because existing oil fields naturally decline. A typical oil field loses 5 to 7% of its production every year as reservoir pressure falls and wells deplete. This means the industry must bring new production online every year just to offset declines from existing fields. If global production is 100 million barrels per day and it declines at 6% annually, you need 6 million barrels per day of new production just to stay flat. You need even more to meet demand growth. Where will this new production come from? U.S. shale oil has been the marginal source of supply growth for the past 15 years. But shale production is plateauing. The best acreage has been drilled. The remaining locations are lower quality. Production costs are rising. Shale will not save us this time. OPEC has spare capacity, maybe 2 million barrels per day that they could bring online if they wanted. But OPEC likes high prices, and they are cutting production to support prices, not increasing it. Russia is under sanctions and struggling to maintain production, let alone grow it. New conventional oil projects in deepwater or remote locations take 7 to 10 years to develop and require billions in upfront investment. Given the underinvestment of the past decade, very few new mega projects will come online before 2030. The gap between demand growth and supply growth means oil prices must rise to balance the market. Higher prices serve two purposes. They destroy demand by making energy expensive, forcing conservation. And they incentivize new supply by making projects economic that were not viable at lower prices. This price adjustment mechanism is already happening. Oil at $80 to $100 destroys enough demand and incentivizes enough supply to balance the market. But that $80 to $100 range is far above the $40 to $60 range that prevailed for most of the 2010s. Sustainably higher prices mean oil is a good investment. Now, let me talk about natural gas because the dynamics are similar but even more compelling in some ways. Natural gas demand is growing faster than oil demand because natural gas is the cleanest fossil fuel and it is essential for electricity generation, heating, and industrial processes. As countries transition away from coal, they are building natural gas power plants. As renewables like wind and solar become more prevalent, you need natural gas to back them up when the wind is not blowing and the sun is not shining. Natural gas demand is projected to grow 3 to 4% annually for the next decade. Meanwhile, natural gas supply faces similar constraints as oil: underinvestment, long development timelines, natural decline rates. The difference is that natural gas is harder to transport than oil. Oil can be loaded on tankers and shipped anywhere. Natural gas must be liquefied at very low temperatures, shipped in specialized LNG tankers, and regasified at the destination. This infrastructure is expensive and takes years to build. The result is that natural gas markets are more regional than oil markets. Europe was dependent on Russian natural gas, and when that supply was cut off due to Ukraine, European gas prices spiked to 10 times normal levels. This created enormous wealth transfer from European consumers to natural gas producers elsewhere. The United States is in a uniquely advantaged position with natural gas. We have abundant supply from shale basins. We have low domestic prices, around $3 per million BTU. We are building LNG export terminals to ship gas to Europe and Asia, where prices are much higher, often $10 to $15. This arbitrage will persist for years because building enough LNG infrastructure to equalize global prices takes a decade. U.S. natural gas producers can sell gas domestically at $3 or export it as LNG at netbacks of $8 to $10. This is extraordinarily profitable. So when I say I would own energy for the next decade, I mean both oil and natural gas. The supply constraints are real and will persist. The demand growth is structural and cannot be easily reduced without causing economic harm. Prices must stay elevated to balance the market. And as an investor, you benefit from sustainably higher prices. How do you actually own energy as a commodity? You have three options. Option one is to buy futures contracts on crude oil or natural gas. This is pure price exposure. If oil goes from $80 to $100, you make 25%. But futures have problems. They require active management. You have to roll contracts as they expire. You can lose money in contango markets where far-dated contracts trade above near-dated contracts. This is too complicated for most investors and too speculative for my taste. Option two is to buy an ETF that holds energy futures. funds like USO for crude oil or UNG for natural gas. These provide passive exposure to commodity prices without having to manage futures yourself. But they still suffer from contango issues and tracking error. Over long periods, these ETFs tend to underperform the actual commodity prices. Not ideal. Option 3, and this is what I actually recommend, is to own energy companies. Buy stock in oil and gas producers like Chevron, Exxon, Occidental Petroleum, ConocoPhillips. These companies give you leveraged exposure to commodity prices. When oil goes from $80 to $100, their profits might double because most of their costs are fixed. Production costs might be $40 per barrel. At $80 oil, they make $40 per barrel in profit. At $100 oil, they make $60 per barrel. That is a 50% increase in profits from a 25% increase in oil price. Better yet, these companies pay dividends. They return cash to shareholders. They are productive assets, not just barrels of oil sitting in storage. They explore for new reserves. They develop fields. They invest in infrastructure. They generate cash flows that compound over time. This is the Buffett way to own commodities. Buy the businesses that produce them. At Berkshire, we own significant positions in Chevron and Occidental Petroleum. We bought Occidental at an average price around $55. Today it trades around $58. We have made modest capital gains, but we have collected substantial dividends, and we own warrants that give us the right to buy more shares at very attractive prices. Our thesis is simple. Oil will trade at $80 to $100 for the next decade. Occidental makes money hand over fist at those prices. They will generate $10 billion plus in free cash flow annually. They will pay dividends. They will buy back stock. They will pay down debt. Over 10 years, the stock will be worth far more than today. We will make excellent returns. This is commodity exposure done right. The second commodity I would own for the next decade is copper. And the supply-demand story for copper is even more compelling than energy. Let me start with demand. Copper is essential for electrification. It is the best conductor of electricity after silver, but silver is too expensive for widespread use. Every electrical system, every motor, every wire, every transformer uses copper. As the world electrifies, copper demand surges. Consider electric vehicles. A conventional gasoline car uses about 20 kilograms of copper. An electric vehicle uses about 80 kilograms. 4 times as much. Every EV requires copper for the battery, the motor, the charging system, the wiring. Global EV sales are growing from around 10 million per year today to a projected 30 to 40 million per year by 2030. This incremental EV production requires an additional 1.8 million tons of copper annually. That is about 9% of current global copper production needed just for the incremental EV demand. Now add in renewable energy. Wind turbines use massive amounts of copper. A single wind turbine uses about 5 tons of copper. Solar installations use copper for wiring and inverters. Offshore wind uses even more copper because of the long cables needed to connect to shore. The world is installing hundreds of gigawatts of renewable capacity over the next decade. This requires millions of tons of copper. Then add in grid infrastructure. As we electrify vehicles and heating and industry, we need to upgrade electrical grids to handle the increased load. Utilities are spending hundreds of billions to replace old transformers, string new transmission lines, build new substations. All of this is copper intensive. The electrification of everything is the most copper intensive economic transformation in history. We are building an entirely new energy infrastructure on top of the existing one. This requires staggering amounts of copper. Total copper demand today is about 25 million tons per year. Demand is projected to grow to 35 to 40 million tons per year by 2035. That is 15 million tons of new annual demand. Where will this supply come from? This is where the story becomes very interesting and very bullish for copper prices. Copper supply is constrained for several reasons. First, copper ore grades are declining. A century ago, copper mines extracted ore with 3 to 5% copper content. Today, the average ore grade is under 0.5%. You have to move 200 tons of rock to get 1 ton of copper. As grades decline, production costs rise. Mines that were profitable at $3 copper require $5 copper to be economic at current ore grades. Second, new copper discoveries are rare and getting rarer. The last major copper discovery was in the 1990s. Since then, very few world-class deposits have been found, despite billions spent on exploration. The easy-to-find, near-surface, high-grade deposits are gone. New deposits are deeper, lower grade, in more remote locations. In less friendly jurisdictions, they are harder and more expensive to develop. Third, development timelines are extraordinarily long. From discovery to production, a new copper mine takes 15 to 20 years on average. You need to drill extensively to define the resource, get environmental permits, which takes years, secure financing, build infrastructure, roads, power, water, construct processing facilities, ramp up production. This timeline means that even if we discovered major new deposits today, they would not produce meaningful copper until the late 2030s. The copper we will consume in 2030 must come from mines that are already producing or are already under construction. Fourth, existing copper mines are depleting. Just like oil fields, copper mines have finite lives. Production from existing mines declines every year as the ore body is extracted. You must constantly bring new mines online just to offset depletion. Given the lack of new discoveries and the long development timelines, replacing depleted production is extremely challenging. Fifth, the political and environmental barriers to new mine development are higher than ever. Communities oppose mines because of environmental concerns. Governments impose strict regulations that delay projects and increase costs. Indigenous groups assert land rights that block development. Permitting that used to take 2 years now takes 10 years. Capital costs for new mines have tripled over the past 15 years due to higher labor costs, higher equipment costs, and more stringent environmental requirements. Many projects that looked economic on paper are no longer viable at current costs. The combination of surging demand and constrained supply creates a structural deficit. Copper demand is growing faster than copper supply can possibly grow. The gap must be closed by higher prices. How much higher? Copper currently trades around $4 per pound. Most analysis suggests copper needs to reach $6 to $8 per pound by the end of this decade to incentivize enough new supply and destroy enough demand to balance the market. That is a 50 to 100% increase from current levels. Unlike oil, where OPEC can turn on spare capacity if prices spike too much, there is no spare copper capacity. No one is sitting on idle copper mines waiting for higher prices. Every economic mine is running full out. The only way to increase supply meaningfully is to develop new mines, which takes 15 to 20 years, or to restart old uneconomic mines by making them economic through higher prices. Either way, supply response is slow. This means copper prices can stay elevated for years. The beauty of copper as an investment is that the demand drivers are locked in. Governments have mandated transitions to electric vehicles. They have mandated renewable energy targets. They have passed infrastructure bills requiring grid upgrades. These policies ensure copper demand growth regardless of short-term economic fluctuations. Even if we have a recession, the long-term electrification trend continues. Even if EV adoption slows in one country, it accelerates in others. The demand growth is diversified across multiple end uses and multiple geographies. It is robust. How do you own copper? Similar to energy, you have 3 options. Option 1 is copper futures. You can buy futures contracts for direct price exposure. But futures have the same issues I mentioned with oil futures. Contango, rollover costs, complexity, not ideal for most investors. Option 2 is copper ETFs. There are funds that hold copper futures or even physical copper. These provide easier access than futures, but they still have tracking issues and fees. Option 3, which I prefer, is owning copper mining companies. Buy stock in companies like Freeport, McMoran, Southern Copper, or diversified miners like BHP and Rio Tinto that have significant copper exposure. These companies give you leveraged exposure to copper prices. When copper goes from $4 to $6 per pound, a 50% increase, mining company profits might triple because most costs are fixed. Cash flow generation explodes. Dividends increase. Stock prices soar.
The challenge with copper mining stocks is that most companies also mine other commodities. Freeport also produces gold. BHP produces iron ore and coal. Rio Tinto is diversified across many metals.
You are not getting pure copper exposure, but you are getting high-quality businesses with long reserve lives, experienced management, and strong balance sheets. Over a 10-year period, these companies will generate substantial returns if copper prices rise, as I expect. Now, let me address the obvious question. Why these two commodities and not others? What about gold, silver, agricultural commodities, rare earth metals, lithium? Let me explain my thinking on each. Gold is the classic commodity that people own as an inflation hedge and store of value. I have famously criticized gold for decades. It produces nothing. It pays no dividends. It just sits in a vault. You are betting that someone will pay more for it later based on fear and uncertainty. That is speculation, not investing. Has my view changed? Not really. I still think gold is a poor long-term investment compared to productive assets. That said, I understand why people own gold. In uncertain times, when fiat currencies are being debased, when governments are running massive deficits, when trust in institutions is low, gold provides psychological comfort. It is a 5,000-year-old store value that governments cannot print. If you believe we are heading into a period of high inflation and currency debasement, gold makes sense, but I am not including it in my two commodities because I cannot make a fundamental supply-demand case for higher gold prices. Gold demand is primarily for jewelry and investment. Both are discretionary and price sensitive. If gold prices spike, demand falls. Supply can increase through recycling and mine production. There is no structural shortage developing like with oil or copper. Gold prices are driven by sentiment and macro factors, not fundamentals. I avoid assets where I cannot anchor value to fundamentals. Silver has some industrial uses in addition to its investment demand. Solar panels use silver. Electronics use silver. But investment demand still dominates. Silver trades more like gold than like copper despite its industrial uses. I would not own it. Agricultural commodities like wheat, corn, soybeans are essential. People need to eat. But agricultural commodity prices are volatile and mean reverting. When prices spike, farmers plant more. Supply increases. Prices crash. When prices crash, farmers plant less. Supply falls. Prices recover. This cycle repeats. Timing is everything, and I am not good at timing. Better to own farmland, which produces crops every year regardless of commodity prices. Farmland is a productive asset that generates cash flows. I own farmland. I do not own agricultural commodity futures. Rare earth metals are critical for many technologies. Electric motors, batteries, wind turbines, electronics. China dominates rare earth production and processing. There are supply chain concerns. Prices could spike. But the rare earth market is small and specialized. Investing in rare earths requires very specific knowledge about individual metals and supply chains. This is outside my circle of competence. I am not including it. Lithium is essential for batteries. Every electric vehicle needs lithium-ion batteries. Demand is surging as EV production ramps up. Supply is constrained. Prices have been volatile. Lithium could be a good investment. But the market is evolving rapidly. New lithium deposits are being developed in multiple countries. Recycling technologies are improving. Sodium-ion batteries might reduce lithium demand in some applications. There is too much uncertainty about the supply response. Copper is a better bet because it is more established and harder to substitute. So I am sticking with energy and copper. These are the only two commodities where I can make a high conviction case that supply and demand fundamentals will drive sustainably higher prices over the next decade. Both have inelastic demand that continues growing. Both have constrained supply that cannot respond quickly. Both are essential and cannot be easily substituted. Both can be owned efficiently through productive businesses that pay dividends and compound value. Let me now talk about position sizing and portfolio allocation, because owning commodities or commodity stocks correctly requires discipline. Commodities are volatile. Prices can swing 50% in a year. You cannot put your entire portfolio into commodity exposure and expect to sleep well at night. You need balance. For a typical investor, I would suggest allocating 5 to 10% of your portfolio to commodity exposure through energy and copper stocks. This is enough to benefit if my thesis plays out, but not so much that volatility destroys your portfolio or your psychology. Within that allocation, I would split evenly between energy and copper. Half in energy companies like Chevron or Occidental, half in copper miners like Freeport-McMoRan or BHP. For more aggressive investors willing to tolerate volatility, you could go up to 15 or 20% in commodity exposure, but I would not go higher. Remember, the core of your portfolio should be quality businesses with durable competitive advantages that generate growing cash flows. Companies like Coca-Cola, Johnson & Johnson, Visa, American Express, these are the wealth builders. Commodities are the diversifiers and inflation hedges. They serve a role, but they are not the foundation. The other critical point is rebalancing. Commodity stocks can have huge runs when prices spike. Your 5% allocation might become 10 or 15% of your portfolio after a big move. When this happens, you must rebalance, sell some commodity exposure and buy more of your core holdings. This forces you to sell high. It is incredibly difficult psychologically because when commodity stocks are flying, you want to hold on and ride the momentum. But discipline requires taking profits and rebalancing. Conversely, when commodity prices crash and your allocation falls from 5% to 2%, you need to rebalance by buying more. This forces you to buy low when everyone else is panicking. In 2020, when oil prices briefly went negative and energy stocks crashed, investors who bought were rewarded massively over the following 2 years. In 2008 and 2009, when copper fell from $4 to $1.50, investors who bought copper miners at the bottom made fortunes. Rebalancing creates these opportunities to buy low and sell high systematically. Now let me address the time horizon question. I said these two commodities for the next decade. Why 10 years specifically? Because commodity super cycles tend to last 8 to 12 years historically. We had a commodity super cycle from 2000 to 2008, driven by China's industrialization. Prices for oil, copper, iron ore, coal all surged. Then we had a 14-year bust from 2008 to 2022. Prices collapsed after the financial crisis and stayed depressed for over a decade due to oversupply and weak demand. We are now in the early stages of a new commodity super cycle. This cycle is driven by different factors than the China cycle: electrification, energy transition, underinvestment in supply, geopolitical fragmentation. But the dynamics are similar. Rising demand meets constrained supply. Prices rise. Producers respond, but slowly. Prices stay elevated for years. Eventually, oversupply develops and prices crash. The cycle repeats. If we are in year 2 or 3 of this cycle, and cycles last 8 to 12 years, we have 5 to 10 years of elevated prices ahead. That is my 10-year time horizon. I am not saying oil will be expensive forever. I am saying it will be expensive for the next decade as the supply shortage works itself out. Eventually, high prices will incentivize enough new production that supply catches up and prices normalize. But that is a late 2030 story, not a 2020 story. For copper, the timeline might be even longer because supply constraints are more severe. New copper mines take 15 to 20 years to develop. Even if we start developing aggressively today, the new supply does not hit the market until 2040. Meanwhile, demand keeps growing. The copper deficit could persist through the 2030s. Copper could be in a structural bull market for 15 to 20 years. This is speculative but plausible. The point is that commodity investments require patience. You are not buying for a quick flip. You are buying for a multi-year trend. You need to be willing to hold through volatility, through corrections, through periods where the thesis seems broken. Oil might fall from $100 to $70 and everyone will say the bull market is over. But if the structural shortage persists, prices will recover. You cannot panic and sell during these corrections. Let me close with some historical context, because seeing how past commodity cycles played out helps build conviction for the current opportunity. In the 1970s, we had a commodity super cycle driven by oil shocks, inflation, and geopolitical instability. Oil went from $3 per barrel in 1970 to $40 by 1980. Copper went from 50 cents per pound to $1.50. Gold went from $35 per ounce to $850. Investors who owned commodity exposure in the 70s made fortunes, while stock and bond investors struggled with stagflation. That cycle ended in the early 1980s when Paul Volcker raised interest rates to 20% to crush inflation. The economy went into deep recession. Commodity demand collapsed. Oil fell from $40 to $10 over the next 2 decades. Copper fell from $1.50 to 60 cents. Gold fell from $850 to $250. The commodity bear market lasted 20 years. Investors who bought at the peak in 1980 lost everything. Then in 2000, a new cycle began. China joined the WTO and started building infrastructure at an unprecedented pace. Chinese steel production went from 150 million tons per year to 800 million tons. This required enormous amounts of iron ore, coal, copper, oil. Commodity prices surged. Oil went from $20 in 2000 to $147 in 2008. Copper went from 60 cents to $4.50. Iron ore went from $20 per ton to $200. Investors who owned commodity stocks in the 2000s made 10 to 20 times their money. That cycle ended with the 2008 financial crisis. Demand crashed, prices collapsed. Then we had 14 years of sideways to down prices as oversupply persisted. China's infrastructure build-out slowed. U.S. shale oil production boomed. Commodity producers kept investing despite low prices because they needed cash flow to service debt. The cycle turned negative. Now in 2022 to 2025, we are entering a new cycle. The drivers are different, but the pattern is similar. Underinvestment in supply, surging demand from new sources, geopolitical supply disruptions, prices rising. This early stage of a commodity cycle is when you want to establish positions. Not at the peak when everyone is excited, at the beginning when the fundamentals are turning, but sentiment is still skeptical. I believe we are in that early stage now for energy and copper. Prices have risen from the lows, but they are not at speculative bubble levels. Sentiment is cautiously optimistic, but not euphoric. Supply deficits are developing, but not yet severe. This is the right time to build positions. 10 years from now, we will look back and see this as the opportunity. Just like buying energy stocks in 2000 or buying commodity stocks in the mid-70s before the big moves. To summarize, the 2 commodities I would own for the next decade are energy, specifically oil and natural gas, and copper. Both have compelling supply-demand fundamentals. Both face structural shortages that will keep prices elevated for years. Both can be owned efficiently through quality businesses that pay dividends and compound value. Both provide inflation protection and portfolio diversification. And both are in the early stages of multi-year bull markets where patient investors will be rewarded. Allocate 5 to 10% of your portfolio to these exposures through energy and copper stocks. Rebalance when allocations drift. Hold through volatility. Think in years, not months. And recognize that you are not speculating on price movements. You are positioning for fundamental economic trends that will drive commodity prices higher as supply struggles to meet demand. This is rational investing based on supply and demand, not gambling on sentiment. And over the next decade, I believe this positioning will generate substantial returns while protecting purchasing power in an inflationary environment. The opportunity is clear. The fundamentals are sound. Now you just need the patience and discipline to execute and hold. Now let me give you much more specific guidance on which companies to buy and how to evaluate them, because picking the right energy and copper stocks is as important as recognizing the commodity opportunity. Not all energy companies are equal. Not all copper miners will benefit equally from higher prices. You need to understand what separates the winners from the losers. For energy exposure, I recommend focusing on integrated oil companies and high-quality independent producers. Integrated companies like Chevron and ExxonMobil own the entire value chain. They explore for and produce oil and gas, which is the upstream business. They refine crude oil into gasoline and diesel, which is the downstream business. They operate chemical plants that turn oil and gas into plastics and other products. This integration provides diversification and stability. When upstream margins are weak because oil prices are low, downstream margins often strengthen because refiners benefit from cheap crude. The businesses offset each other. Chevron is one of the highest quality energy companies in the world. They have a market cap of about $300 billion. They produce about 3 million barrels of oil equivalent per day. Their production is diversified across multiple countries and basins. Permian Basin in Texas, Kazakhstan, Australia, Gulf of Mexico, and others. This geographic diversification reduces political risk. They are not dependent on any single country or any single asset. Chevron's balance sheet is fortress strong. They carry about $25 billion in net debt against annual EBITDA of over $40 billion. That is less than 1 times debt to EBITDA. Very conservative. This financial strength allows them to maintain the dividend even when oil prices fall. Chevron has paid dividends for over 100 consecutive years. They increased the dividend for 36 consecutive years. The current dividend yield is about 3.5%. At $80 oil, they generate about $25 billion in free cash flow annually. They return most of this to shareholders through dividends and buybacks. If oil averages $90 for the next decade, which I expect, Chevron will generate about $30 billion per year in free cash flow. Over 10 years, that is $300 billion in cumulative cash generation. The current market cap is $300 billion. You are essentially buying 10 years of cash flows for the current stock price, and you still own the company and all its assets at the end. That is attractive value. ExxonMobil is similar to Chevron, but larger. Market cap about $450 billion. Production about 4 million barrels per day. Equally strong balance sheet and dividend history. The current yield is about 3.2%. Both Chevron and Exxon are high quality ways to own energy exposure. You cannot go wrong with either.
For more leveraged exposure to oil prices, consider independent producers like Occidental Petroleum and ConocoPhillips. These companies focus purely on upstream production.
They do not have refining or chemicals businesses.
This makes their earnings more volatile, but also gives them more operating leverage to oil prices. When oil rises, their profits can double or triple because their cost structure is largely fixed.
Berkshire owns about 25% of Occidental Petroleum. We bought at an average price around $55. The stock trades around 58 today. Occidental produces about 1.3 million barrels of oil equivalent per day, about 60% oil and 40% gas. Their production is concentrated in the Permian Basin and the DJ Basin in Colorado. They also have operations in the Middle East and Latin America. What I like about Occidental is their low-cost structure. Their production costs are around $25 to $30 per barrel all in. At $80 oil, they make $50 to $55 per barrel in profit margin.
They generate about $10 billion per year in free cash flow at current prices. They are using this cash flow to pay down debt and return cash to shareholders. The dividend yield is about 1.5% and growing.
They also buy back stock aggressively. Over the next decade, if oil averages $85 to $90, Occidental will generate over $100 billion in cumulative free cash flow. The current market cap is about $55 billion. You are buying almost $2 of future cash flow for every dollar of current market cap. That is compelling value. The stock should double or triple over 10 years from cash generation alone, not even accounting for potential multiple expansion if sentiment toward energy improves. ConocoPhillips is another high-quality independent. Market cap about $140 billion, production about 1.8 million barrels per day. Diversified across North America, Europe, Asia, and the Middle East. Very strong balance sheet. They generate about $15 billion per year in free cash flow at current oil prices. Dividend yield about 3%. They return all free cash flow to shareholders through dividends and buybacks. Over a decade, this disciplined capital return will drive substantial shareholder value. For natural gas exposure specifically, consider companies like EQT Corporation or Chesapeake Energy that focus on U.S. natural gas production. These companies benefit from the arbitrage between low U.S. natural gas prices and high international LNG prices. As more LNG export capacity comes online, U.S. natural gas prices should rise from current levels around $3 to closer to $4 or $5 to incentivize production. This price increase would dramatically boost profitability for pure-play gas producers. Now let me talk about how to evaluate these companies beyond just looking at production volumes and debt levels. There are specific metrics you should monitor quarterly to ensure your investment thesis remains intact. The first metric is production growth. Energy companies should be growing production, at least modestly, typically 3 to 5% per year. If production is declining, that is a red flag unless the company is intentionally high-grading their portfolio. Declining production eventually means declining cash flows unless prices rise enough to offset volume losses. The second metric is reserve life. This measures how many years of production the company can sustain at current production rates based on proven reserves. A healthy energy company should have at least 10 years of reserve life. If reserve life is shrinking, the company is not replacing the reserves they are depleting. Eventually, they run out of inventory and the business dies. Companies like Chevron and Exxon have 15 plus years of reserve life. They are constantly adding new reserves through exploration and acquisitions. The third metric is finding and development costs. This measures how much the company spends to add each barrel of new reserves. Good companies find and develop reserves for less than $30 per barrel. Poor companies spend $50 or $60 per barrel. If finding costs exceed the price of oil, the company is destroying value by growing production. This is why I focus on high-quality companies with low-cost structures and efficient operations. The fourth metric is return on capital employed, known as ROCs. This measures how much profit the company generates for each dollar of capital invested in the business. Good energy companies generate ROCE of 15 to 20% at mid-cycle, oil prices around $70. This means every dollar invested returns 15 to 20 cents annually. Companies with low ROCE are capital inefficient. They spend a lot but generate weak returns. Avoid them. The fifth metric is free cash flow yield. This is annual free cash flow divided by market cap. A healthy energy company at current oil prices should generate free cash flow yield of 8 to 12%. Chevron at $300 billion market cap, generating $25 billion. Free cash flow has an 8.3% free cash flow yield. This is attractive. If a company has free cash flow yield below 5%, it is expensive relative to cash generation. Now let me talk about copper companies using the same framework. The challenge with copper is that very few companies are pure-play copper miners. Most diversified miners produce copper alongside other metals like gold, iron ore, coal. This dilutes your copper exposure, but it also provides diversification within the mining investment. Freeport-McMoRan is the closest thing to a pure copper play among large-cap miners. About 75% of their revenue comes from copper. The remaining 25% comes from gold and molybdenum, which are byproducts of their copper mining. Freeport has market cap of about $50 billion. They produce about 4 billion pounds of copper annually from mines in North America, South America, and Indonesia. Their flagship asset is Grasberg in Indonesia, one of the largest copper and gold deposits in the world. They also operate multiple mines in Arizona and New Mexico and mines in Chile and Peru. This geographic diversification is valuable. They are not dependent on any single jurisdiction. If one country raises taxes or imposes restrictions, they have production elsewhere. Freeport's cost structure is competitive. Their all-in sustaining costs are around $2.50 to $3 per pound of copper. At current copper prices, around $4, they generate healthy margins of $1 to $1.50 per pound. On 4 billion pounds annually, that is 4 to 6 billion in annual margin. At $6 copper, which I expect within 5 years, margins would be $3 per pound times 4 billion pounds equals 12 billion annually. The profit leverage to higher copper prices is enormous. Freeport currently generates about $5 billion per year in free cash flow. Market cap is $50 billion. That is a 10% free cash flow yield. Reasonable but not cheap. However, if copper rises to $6, free cash flow would increase to 12 to 15 billion per year on the higher margins and modest production growth. That would be a 25 to 30% free cash flow yield on today's market cap. The stock would likely double or triple to normalize the valuation. This is how you make money on commodity stocks. Buy before prices rise, hold while the higher prices drive profit growth, sell when valuations become expensive. BHP Group is a diversified miner with significant copper exposure. They produce about 1.7 million tons of copper per year. About 30% of their revenue comes from copper. They also produce iron ore, met coal, nickel, and potash. Market cap is about 120 billion. The diversification provides stability. When copper is weak, iron ore might be strong. When iron ore is weak, coal might be strong. You get exposure to multiple commodity cycles. BHP operates some of the world's largest and lowest cost copper mines. Escondida in Chile is the single largest copper mine on Earth, producing over 1 million tons per year. BHP owns 57.5%. Olympic Dam in Australia is another massive copper resource. Spence and Pampa Norte in Chile. Resolution Copper in Arizona, which is under development. These are Tier 1 assets with decades of mine life and low costs. BHP's balance sheet is pristine. Net debt of about 10 billion against EBITDA of over 30 billion, less than half a turn of leverage. They pay a dividend yield of about 5%, much higher than most miners. They have a progressive dividend policy, which means the dividend never goes down, it only goes up or stays flat. This provides income stability. Over the next decade, as copper prices rise, BHP will generate substantial free cash flow, which will be returned to shareholders through higher dividends and buybacks. Rio Tinto is similar to BHP, diversified miner with copper exposure. They produce about 600,000 tons of copper per year from mines in Mongolia, Chile, and the United States. About 20% of revenue from copper. The rest from iron ore, aluminum, and other metals. Market cap about 100 billion. Strong balance sheet. Dividend yield about 6%. High quality operator with a long history of capital discipline. For copper exposure, I would split my allocation among these three companies. 1/3 Freeport for maximum copper leverage, 1/3 BHP for diversification and dividend income, 1/3 Rio Tinto for similar reasons. This gives you exposure to different geographies, different mine types, and different management teams. If one company faces operational issues or political problems, the others offset. The metrics to monitor for copper miners are similar to energy companies, but with some differences. First, production growth. Copper companies should be growing production 3 to 5% per year through expansion projects and new mine development. Flat or declining production is a red flag. Second, reserve life. Copper mines should have 15 plus years of reserves at current production rates. If reserve life is shrinking, the company is not replenishing what they mine, they are liquidating. This is unsustainable. Third, all-in sustaining costs, known as AISC. This measures total costs to produce copper, including mining, processing, transportation, royalties, taxes, sustaining capital. Good copper miners have AISC below $3 per pound. Average miners are $3 to $4. High-cost miners are above $4. You want to own the low-cost producers because they make money even when copper prices are weak. Fourth, return on invested capital.
Copper mining is capital intensive. You must invest billions to develop new mines. Good miners generate ROIC of 12 to 15% on these investments.
Poor miners generate ROIC of 5 to 8%. The difference compounds enormously over time. Fifth, free cash flow conversion. Mining companies often report strong EBITDA but weak free cash flow because they must constantly reinvest in sustaining capital to maintain production. Good miners convert 50 to 60% of EBITDA to free cash flow. Poor miners convert 20 to 30%. The difference goes to sustaining capital, which is essentially a tax on the business. Now let me discuss risk management, because commodity investments carry specific risks that require active monitoring. The biggest risk is price volatility. Oil could fall from $80 to $60 in a recession. Copper could fall from $4 to $3 on weak Chinese demand. These price swings are normal and expected. You cannot panic when they happen. The way to manage price risk is through position sizing and diversification. Never put more than 10 to 15% of your portfolio in commodity exposure total. Within that, split between energy and copper. Within energy, own multiple companies. Within copper, own multiple companies. This diversification ensures that no single price movement or company-specific issue destroys your portfolio. The second risk is operational. Mines can have accidents, floods, strikes, equipment failures. Oil wells can have blowouts or mechanical issues. These events disrupt production and hurt cash flows. Company-specific operational risk is why you own multiple companies. If Freeport has a problem at Grasberg, your BHP and Rio Tinto holdings offset. The third risk is political and regulatory. Governments can raise royalties, increase environmental requirements, or even nationalize assets. This is particularly relevant in developing countries. Chile is considering higher mining royalties. Indonesia has changed contract terms for Grasberg multiple times. Peru has political instability. This is why geographic diversification matters. Own companies with assets spread across multiple countries so no single political event devastates your position. The fourth risk is the energy transition. Some people believe oil and gas demand will collapse as the world transitions to renewables and electric vehicles. This would obviously hurt energy companies. My view is that this transition will take much longer than most expect. Oil and gas will be essential for decades, but it is a risk to acknowledge. The mitigation is the time horizon. I am recommending energy for a decade, not forever. Within 10 years, I expect energy companies to generate enough cash flow to return your entire investment through dividends and buybacks. After that, if demand does collapse, you have already made your money. For copper, the energy transition is actually bullish, not bearish. Electrification increases copper demand. The risk is substitution. Could aluminum replace copper in some applications? Could improved efficiency reduce copper intensity? Unlikely on a scale that matters, but worth monitoring. Now, let me walk through detailed financial scenarios showing potential returns over 10 years, because seeing the math makes the opportunity concrete. Scenario 1 is base case. Oil averages $85 per barrel for 10 years. Copper averages $5 per pound. You invest $100,000, $50,000 in energy stocks, $50,000 in copper stocks. Your energy allocation is split among Chevron, Occidental, and ConocoPhillips. These companies generate combined free cash flow yield of 9% at $85 oil. Over 10 years, you collect about $45,000 in dividends, assuming modest dividend growth of 4% annually. The stocks appreciate at 6% annually as earnings grow and multiples stay constant. Your $50,000 grows to about $90,000 in stock value. Total return on energy portion is $90,000 in stock value, plus $45,000 in dividends equals $135,000. You more than doubled your money. Your copper allocation is split among Freeport, BHP, and Rio Tinto. At $5 copper, these companies generate free cash flow yield of 10%. Over 10 years, you collect about $55,000 in dividends, assuming 5% annual dividend growth. The stocks appreciate at 7% annually on earnings growth. Your 50,000 grows to about 98,000 in stock value. Total return on copper portion is 98,000 plus 55,000 equals 153,000. You tripled your money. Combined, your 100,000 investment becomes 288,000. Total return of 188% over 10 years. That is about 11% compound annual return. Very attractive, especially considering you owned stable dividend-paying businesses with strong balance sheets, not speculative junk. Scenario 2 is bull case. Oil averages $100 per barrel for 10 years due to severe supply shortages. Copper averages $7 per pound as the electrification boom exceeds expectations. Same $100,000 investment split evenly. Your energy stocks generate free cash flow yield of 13% at $100 oil. Over 10 years, you collect about $70,000 in dividends with higher growth rates of 6% annually on the higher base. Stock prices appreciate at 10% annually as earnings surge and multiples expand on strong sentiment. Your $50,000 grows to $130,000 in stock value. Total return is $130,000 plus $70,000 equals $200,000. You quadrupled your money. Your copper stocks generate free cash flow yield of 18% at $7 copper. Over 10 years, you collect about $100,000 in dividends with strong growth. Stock prices appreciate at 12% annually. Your $50,000 grows to $155,000 in stock value. Total return is $155,000 plus $100,000 equals $255,000. You made 5 times your money. Combined, your $100,000 becomes $455,000. Total return of 355% over 10 years. That is about 16% compound annual return. Exceptional returns that would dramatically outperform stocks and bonds over this period. Scenario 3 is bear case. Recession hits, oil averages $70 for 10 years, copper averages $3.50. Same $100,000 invested. Your energy stocks generate free cash flow yield of 6% at $70 oil. Over 10 years, you collect about $30,000 in dividends with slow growth. Stock prices are flat to down as sentiment is negative. Your $50,000 is worth about $45,000 in stock value after a decade of malaise. Total return is $45,000 plus $30,000 equals $75,000. You lost money in nominal terms, though dividends cushioned the blow. Your copper stocks generate free cash flow yield of 5% at $3.50 copper. Over 10 years, you collect about $25,000 in dividends. Stock prices decline as earnings compress. Your $50,000 is worth about $40,000. Total return is $40,000 plus $25,000 equals $65,000. You lost money here too. Combined, your $100,000 becomes $140,000. Total return of 40% over 10 years. That is about 3.4% compound annual return. Not good, but not catastrophic. You still made some money, despite commodity prices being weak for a full decade. The asymmetry is clear. In the base case, you double or triple your money. In the bull case, you quadruple or quintuple your money. In the bear case, you make modest returns but do not lose your shirt. The risk-reward is attractive. You have multiple ways to win and limited downside if you are wrong. Now let me address tax considerations because taxes significantly impact returns on commodity investments. Energy and copper stocks pay qualified dividends which are taxed at 15 or 20% depending on your bracket. This is favorable treatment compared to ordinary income which can be taxed at 37%. The dividends you collect keep more after tax value. Capital gains on stocks held over 1 year are also taxed at 15 or 20%. If you hold your energy and copper stocks for the full 10 years and then sell, your gains are taxed favorably. On 100,000 that grows to 300,000, you have 200,000 in gains. At 20% long-term capital gains rate, you owe 40,000 in taxes. You net 260,000 after tax. Still very attractive. However, if you trade in and out frequently, trying to time commodity price swings, you trigger short-term capital gains tax as ordinary income. This tax inefficiency will destroy your returns. You must have the discipline to buy and hold for years, not months. The optimal account structure is to hold commodity stocks in taxable accounts rather than retirement accounts if possible. Why? Because in retirement accounts you defer taxes but eventually pay ordinary income tax on all withdrawals. The qualified dividend and long-term capital gains treatment is wasted. In taxable accounts, you get the benefit of favorable tax treatment on dividends and gains. The exception is if you are reinvesting all dividends during accumulation phase. Then holding in a retirement account makes sense to avoid paying taxes on dividends you are not spending. But once you are retired and spending dividends, taxable account is better for commodity stocks. Let me close with very specific action steps you can implement today to position for the commodity opportunity. Step 1 is to assess your current portfolio allocation. How much do you currently have in energy and commodity exposure? Most investors have zero or minimal exposure because these sectors have been out of favor for over a decade. If you have less than 5%, you are underexposed given the opportunity. Step 2 is to determine your target allocation based on risk tolerance. Conservative investors might allocate 5% total to commodities. Moderate investors might allocate 8 to 10%. Aggressive investors might go 12 to 15%. Beyond 15% is speculation, not prudent allocation. Step 3 is to select specific companies. For energy, I recommend owning at least 2 companies for diversification. Chevron plus either Occidental or ConocoPhillips. For copper, own at least 2 companies. Freeport plus either BHP or Rio Tinto. This gives you adequate diversification without overcomplicating. Step 4 is to implement gradually. Do not deploy all your capital at once. Scale in over 3 to 6 months. This averages your entry price and prevents you from buying right before a correction. Invest 1/3 now, 1/3 in 3 months, 1/3 in 6 months. Dollar cost averaging removes emotion and timing risk. Step 5 is to establish monitoring discipline. Review your commodity holdings quarterly when companies report earnings. Check the metrics I outlined: production growth, reserve life, cost, return on capital, free cash flow. As long as these metrics remain healthy, hold. If they deteriorate for multiple quarters, investigate whether the thesis has changed. Step 6 is to rebalance annually. Once per year, check your actual allocation versus your target. If commodity stocks have run up and now represent 12% when your target was 8%, sell some and rebalance. If they have underperformed and now represent 5% when your target was 8%, buy more to rebalance. This discipline forces you to sell high and buy low systematically. Step 7 is to set a time horizon and commit to it. You are buying for a decade, not a quarter. Commodity prices will be volatile. Your stocks will swing. You must have the conviction to hold through corrections and noise. The only way to do this is to deeply understand the thesis. Reread this analysis when you are tempted to sell. Remember the supply constraints and demand growth. Trust the fundamentals, not the daily price action. These 7 steps, executed with discipline, will position you to benefit from what I believe will be a historic commodity bull market over the next decade. Energy and copper face structural shortages that cannot be resolved quickly. Demand keeps growing while supply struggles to keep pace. Prices must stay elevated to balance the market. Companies that produce these commodities will generate exceptional cash flows and returns. You just need the patience to buy and hold while the thesis plays out. The opportunity is clear. The fundamentals are sound. Now you must decide whether you have the discipline to execute. The next decade belongs to those who position early for the commodity super cycle. Make sure you are one of them.